The budget 2023, which is the last one before the 2024 general elections, was expected to bring some tax respite. The budget did not have any big bang announcements on the direct tax front. Rather, the focus was on addressing certain visible challenges and anomalies while steering clear of the freebies culture. What did the budget 2023 cover? For starters, there were clear changes affecting the salaried class. The new tax regime, which tried to stick to the path of rationalizing the exemptions and deductions, did not find favor with the salaried class. The finance minister made changes to the structure to enable a more robust adoption of the new tax regime. Along with the changes in the slab structure, the FM also rationalized provisions related to leave encashment, exemption of life insurance policies, and TDS on provident fund due to an employee. The high net worth individuals also had a respite, with the FM lowering the surcharge on incomes in excess of Rs 5 crore under the new tax regime. However, one area where high net worth individuals stands impacted is the limitation of the benefit under Section 54 and 54F being restricted to capital gains up to Rs 10 crores. What this means is that high net worth individuals can no longer claim the exemption from capital gains by investing amounts in excess of Rs 10 crores. This could see some impact on the growth in the luxury housing market. On the corporate tax side, few sectors have received attention. The FM, in her speech, alluded to the financial sector being one of the Saptarishi to guide in the Amrit Kaal. She made true to the promise by focusing on this sector. The changes proposed include additional tax on incentives to the International Financial Services Center, changes in Section 72A dealing with the carry forward and set off of accumulated loss and depreciation in case of strategic disinvestment. This change is proposed to accelerate banking company disinvestment, including that of IDBI Bank. And finally, excluding non-banking financial corporations from the restrictions on interest deductibility under Section 94. Startups received a special mention in the economic survey, and as expected, there were some changes addressing the needs of the startup community. The benefit of Section 80 IAC had been extended by 1 year, and certain provisions related to the carry forward and set off of business losses in the case of change in shareholding has been rationalized. The online gaming industry has grown at a rapid clip over the last few years, but the withholding tax provisions has not kept pace. To address this, amendments have been proposed in the current budget. Obviously, the fine print will reveal how this nascent growth industry will respond to the changes. The budget also focused on administrative changes to ensure effective functioning of the Act, including introduction of the authority of Joint Commission Appeals, rationalization of appeals at ITAT, and alignment of certain timelines and measures related to faceless schemes introduced. While much will be written about the budget in the coming days, it may be worthwhile noting what the budget failed to touch. One big bang expectation was the dispute resolution scheme for direct taxes. While the FM spoke about the need to have contractual settlement of disputes, it would have been opportune to also introduce a dispute resolution scheme, which was the expectation of corporate taxpayers. Another area where the changes were expected was in the area of capital gains, which largely remained untouched. Now, what's the takeaway from this budget? Well, largely the finance minister steered clear of large changes and focused on incremental changes that would rationalize the tax laws. I will now hand it over to my colleague Gunjan, who will speak on the indirect tax proposals.
Thank you, Rani. This year's budget was expected to focus on fiscal consolidation and long-term growth, given the global recession and geopolitical conditions. The biggest outlier in this year's budget is the infusion of capital investment outlay of Rs 10 lakh crores. The budget proposals clearly aim to promote exports, boost domestic manufacturing, enhance domestic value addition, have fewer tax rates, encourage green energy and mobility. On the GST front, the budget 23-24 has proposed few amendments in CGST and IGST Act, and largely there are rate changes introduced under customs law. The industry at large was keenly awaiting some favorable changes under the GST law, However, there are no significant favorable changes as such under the indirect tax regime. Government has essentially given effect to discussions held at the 48th GST Council meeting. Some of the key changes proposed are as follows. The budget has proposed to raise the minimum threshold for launching prosecution under GST from 1 crore to 2 crores. Decriminalize certain offences specified under Section 132 of the CGST Act pertaining to obstruction or preventing any officer in discharge of his duties, deliberate tampering of any material evidence, or failure to supply any information. Further, taxpayers below the aggregate turnover of 50 lakh rupees and engaged in supply of goods through e-commerce operators can now opt to pay tax under composition levy. Very interesting change proposed with respect to place of supply of services for transportation of goods. The place of supply of services for transportation of goods outside India, where provider and recipient are both located in India, has been amended to be the location of recipient as opposed to the destination of goods. Yet another interesting change is OIDR service provider located outside India would have to pay tax in India when recipient is an unregistered person irrespective of the purpose. Further, two key criteria to qualify as OIDAR, which were essentially automation and minimal human intervention, both have been deleted. From a customs standpoint, this year's budget has focused on rationalization of customs duty on raw materials and increase in import duties on certain products to spur domestic production. There is a reduction in customs duty for certain products such as seeds for use in manufacture of lab-grown diamonds from 5% to nil, camera lens and inputs parts for use in manufacture of camera module of cell from 2.5% to nil, parts for manufacture of open cell TV panel from 5% to 2.5%. Furthermore, there is an increase in customs duty to boost domestic manufacturing, SKD vehicle from 30 to 35%, specified CBU from 60 to 70%, specified CBU EV vehicles from 60 to 70%, and bicycle and toys, compounded rubber, and quite a few more. There's an increase in national calamity contingent duty rates on specified cigarettes. There is exclusion of solar power plant, solar power project from the purview of project imports. There is an exemption to specific capital goods machinery for manufacture of lithium ion cell for use in battery of EVs and vehicles as well. These were the rate changes. However, in my view, one of the most unfavorable changes proposed is the disallowance of input tax credit on CSR expenditure. And in fact, when the finance minister talked about reduction in number of rates and simplification of compliances, the first thought that came to my mind was that there will be reduction in the number of rates under GST and there will be simplification in GST compliances. However, while the industry continues to represent to seek redressal to their issues faced under GST and customs, we at BDO India will keep you posted on developments from time to time. Thank you.